When reports emerged that Federal Reserve Chair Jerome Powell was facing a criminal investigation by the U.S. Department of Justice, markets initially braced for turbulence. The inquiry reportedly centers on a $2.6 billion renovation of the Federal Reserve's headquarters in Washington, a case Powell himself described in unusually blunt language as a political pretext aimed at pressuring the central bank into cutting interest rates. Futures markets reacted swiftly, pricing in uncertainty. Yet when trading officially began, the expected shock failed to materialize. While gold and silver surged, signaling a defensive response, U.S. equities remained largely stable and the dollar barely moved. For economist Tyler Cowen, a prominent libertarian thinker at George Mason University and author of the widely read Marginal Revolution blog, this lack of market panic is the most revealing aspect of the episode. According to Cowen, the calm response does not reflect confidence in government motives, but rather a deeper and more troubling reality. Investors have already accepted that the Federal Reserve's independence has been structurally eroded. Speaking on the technology-focused TBPN podcast, Cowen argued that the damage was not caused by any single political confrontation, but by years of fiscal policy decisions that have steadily constrained the central bank's real freedom of action. Persistent budget deficits, repeated tax cuts, and expanding government spending have created conditions in which monetary independence becomes increasingly theoretical. In Cowen's view, the fundamental issue lies in the scale of U.S. debt. As debt and deficits grow, he argues, inflation becomes an almost inevitable outcome, not because policymakers explicitly choose it, but because democracies tend to prefer inflation over politically painful alternatives, such as higher taxes or deep spending cuts. This dynamic, Cowen suggests, quietly undermines central bank independence even in the absence of overt political interference. In highly indebted democracies, monetary choices become constrained by fiscal realities. Over time, inflation becomes the least politically costly way to manage obligations that voters are unwilling to finance directly. This perspective closely mirrors the long-standing warnings of Ray Dalio, founder of Bridgewater Associates, who has repeatedly highlighted what he calls the big cycle of debt. Dalio's framework suggests that heavily indebted nations eventually face a narrowing set of options: severe austerity, default, or inflation. For a country issuing currency, default is unthinkable, leaving inflation as the most likely path forward. Dalio has frequently argued that inflation functions as an invisible tax, one that democracies consistently prefer to overt fiscal tightening. In a recent conversation with Carlyle Group co-founder David Rubenstein, Dalio remarked that future generations would effectively repay today's debts through a gradual erosion of the dollar's purchasing power. Cowen has offered a sobering projection of how such a process might unfold. He estimates that the United States could require several years of inflation around 7% annually to meaningfully reduce the debt burden relative to the size of the economy. While deeply unpleasant, he argues, this outcome may already be locked in by past choices. Such a scenario would likely involve lower living standards and periods of labor market stress. Yet Cowen contends that alternatives are limited. Given the United States' unique position as the largest economy in history and issuer of the global reserve currency, traditional exits such as default remain implausible. Ironically, this same privileged status allows the U.S. to sustain higher debt levels than almost any other nation, a short-term advantage that can weaken long-term political discipline. It also helps explain why markets appear less reactive to institutional pressure on the Fed. Investors may already believe that monetary independence has been functionally compromised. While neither Cowen nor Dalio has directly tied their debt arguments to the personal conflict between Powell and former President Donald Trump, the underlying tension is similar. Trump has repeatedly pushed for lower interest rates, arguing they would reduce mortgage costs and improve housing affordability. However, such cuts risk fueling future inflation, potentially exacerbating long-term instability. This concern has been echoed by Albert Edwards, the outspoken global strategist at Societe Generale. In comments to Fortune late last year, Edwards warned that uncontrolled inflation remains the most likely outcome, given the lack of political appetite for deficit reduction. There is, however, one potential variable that could alter this trajectory: productivity growth driven by artificial intelligence. Cowen has acknowledged that a sustained increase in productivity, even by 1 percentage point annually, could allow the U.S. to grow its way out of the debt trap without relying on prolonged inflation. Still, he remains skeptical. Roughly half of the U.S. economy, including government services, higher education, much of healthcare, and the non-profit sector, is structurally AI may improve efficiency at the margins. Cowen doubts it will deliver the transformative output needed across these sectors. Without a broad-based productivity breakthrough, debt dynamics may continue to outpace technological progress. The result, Cowen warns, is a more fragile era for the U.S. dollar, one shaped by rising inflation risks, fiscal constraints, and diminished confidence in institutional independence. As Cowen put it, concerns about the Federal Reserve's independence may be arriving late. The structural forces undermining it have been in motion for years. At the same time, recent data adds nuance to the picture. New GDP figures show annualized productivity growth of 4.9%, prompting cautious optimism among some economists. Analysts at Morgan Stanley noted that while much of the increase appears cyclical, the true drivers behind the acceleration remain uncertain. Whether this represents a turning point or a temporary reprieve remains an open question.